If you tried walking into a big bank recently to get a small business loan, you already know the brutal truth. They don't want to talk to you. Big bank approval rates are sitting at a measly 13.3%. But while traditional banks are closing their doors to small businesses, a massive alternative market has quietly exploded to over 150 billion. It's called peer-to-peer lending. No, I'm not a CPA, so always be sure to check with one for any tax or financial advice. But today we're breaking down the shocking data behind P2P loans, why traditional banks are losing this war, and the hidden traps you must avoid if you want to do it at scale. Let's look at the numbers. According to industry data, alternative and online marketplace lenders boast a 28.4% approval rate. That is double the chance of getting a yes compared to a major financial institution. And why is that? Because P2P lending cuts out the bank completely. Instead of one rigid corporate underwriter judging your business, P2P platforms connect you directly with individual and institutional investors. A computer algorithm evaluates your business metrics, assigns you a risk grade, and lets multiple investors chip in to fund your loan. The global market for this is growing at a staggering 24.2% compound annual rate and is projected to hit 705 billion by 2030. There are three massive reasons why business owners are bypassing traditional banks for P2P. One is speed. Banks take 2 to 8 weeks to process a loan. P2P platforms use automated algorithms to fund accounts in 24 to 72 hours. Two, lenient credit. Most banks demand a personal credit score of 680 to 720. P2P platforms routinely approve owners with scores in the 580 to 640. No collateral required. A lot of these marketplace loans are completely unsecured. You don't have to pledge your house or your company equipment just to get a cash injection. But stop before you hit apply, because that leniency comes at a massive cost, and it's called risk-based pricing. Traditional bank term loans usually cap out around 13% APR. P2P business loans, however, feature a massive spread, ranging from 7.9% all the way up to about 36% APR. The average rate for P2P business loan sits about 19.8. If your credit score is a 590 and your bookkeeping is messy, you aren't getting that beautiful 8% rate. You're getting slapped with a 35% interest rate. If you take out a $100,000 loan to buy inventory, you could end up paying back nearly $140,000. And that's not a growth strategy, that is a debt spiral. Here is the Bankable Books solution. P2P lenders use AI algorithms to read your numbers. They look at your bank statements for the last 3 to 6 months and your year-to-date financial data. They are searching for stability. Over 42% of P2P loans are used purely for working capital and cash flow. If your books are messy, or if you have sudden wild swings in your revenue because you aren't invoicing properly, the algorithm flags you as high risk and automatically bumps you into that 30% interest rate bracket. But if your books are clean, reconciled daily, and prove steady, predictable monthly cash flow, you force the algorithm to give you a lower risk grade and lower interest rate. Peer-to-peer lending is an incredible, powerful alternative to traditional banks, but only if you control the narrative and your data. Don't let a sloppy ledger cost you tens of thousands of dollars in high interest. If you want to make sure your numbers are optimized before you apply to a marketplace lender, I am a certified QuickBooks ProAdvisor and I can help. Thanks for watching, and we'll see you in the next one.